Hi everyone, this is Rob Roy, and welcome to the Elliott Wave Elite U.S. Market Update. Markets continued lower as we talked about in last week's recording, although we have the ABC corrective patterns labeled on the primary Elliott Wave chart. The one we're focusing on is the downward zigzag pattern, so I'll take this off just to clean up the chart a little bit and remind you that we had the 61.8% correction that occurred here, and that set up a qualified downward zigzag pattern that you would label as A, the corrective move to the upside, B, and then a potential downward C wave. And we also talked about how it was a qualified pattern. You have to pay attention to the patterns when they qualify. It would go against the seasonal trends, however, but that's what it was showing on the Elliott Wave zigzag pattern, especially when combined with the Fibonacci ratios. So down around 2470 would be the completion of 100% extension if we get that far on the SPX, meaning that the C wave could continue lower. Now, we talked about the fact that it was against the seasonal trends, and the end of last week with the Thanksgiving holiday here in the U.S. For those of you that may not be familiar with how the markets work around Thanksgiving in the U.S., we are closed on Thursday for a full day, and then the markets are open half a day on Friday, closing at 1 p.m. New York time. So if we move over and look at the SPY to bring volume into the mix, you'll be able to see how the volume dropped off. So those last two bars would be, the first one would be Wednesday's trade, where a lot of people leaving early for the holiday, and then Friday almost nobody comes in, so there's very little going on. So from that standpoint, with the volume, the fact that the volume was so low, you don't pay any attention to it, and really you just don't pay any attention to what happens on that Wednesday and Friday anyway because of the low volume. But what's unusual is those are normally days where the market finishes to the upside. Historically, a very high percentage of the time, those are up days, and you can see that we had down days here both on Wednesday and Friday. I expected that we would drift back up and close this gap in the SPY chart that occurred on Tuesday, but that didn't happen. Now, maybe that does occur back when the markets reopen again on Monday. That we go up and close that gap. I would like to see that gap closed just because of the fact that we know gaps get closed, and when that happens is anybody's guess. So we to continue down to our C wave extension, we would obviously want to take out this low and see that occur. I've been mentioning that there hadn't been this catastrophic low yet, which was another reason to believe that we could continue lower in the markets. In other words, we haven't had that big volume blast out to the downside. I mean, we had elevated volume when the correction started, when this downward zigzag started, right at the beginning of the impulse A wave there, but not the cathartic volume where you just have where it's almost panic selling. Now, I do think if we take out this low that occurred on the 29th, we could see that. But the thing that bothers me is a lot of pundits on the networks are talking about that now, and usually when everybody is thinking the same thing, the market doesn't do that. So maybe it still happens, but I guess my point is that we can continue lower, reach our C wave target to the downside, and that end the correction without the cathartic sell-off. I would still prefer to see it. It's just something to mention on the way markets tend to act. So people are saying that, why is this occurring? The economy isn't that bad. Well, the economy has ticked down a little bit. Inflation's ticked up a little bit. Federal Reserve is raising rates a little bit, but the problem is they're actually withdrawing liquidity as well, and that's an issue. But one thing that not a lot of people are talking about is the fact that we have $9 trillion of corporate debt. There's a big corporate debt bubble that's wobbling around looking like it might want to pop. And the reason for that, now $9 trillion is not new. To give you a perspective, at the end of 2009, when the last financial crisis occurred, the corporate debt was about half that. So we've basically doubled the amount of corporate debt, and the reason for that was the low interest rates. So the Federal Reserve has had money almost free for a while, and corporations were using that money, accessing the markets, and using it to buy back shares, which I don't think that was a very smart use of it, but that's what companies were doing. And so they've gone into significant debt and used a great deal of it, as I mentioned, to buy back their shares, which I don't know, almost seems like they shouldn't be allowed to do that. That if they're going to buy back shares, they need to do it from profits, not from going further into debt. But the problem is, now that they've got these bulging balance sheets with the debt, any little tick up in interest rates becomes a significant problem. So it's not just that the Federal Reserve has raised rates a few times, 25 basis points at a time, and historically rates are still a little bit on the low side. The problem is the fact that any movement upward in rates causes severe hardship for a lot of these corporations in order to meet their debt obligations. Now, the markets could be looking at that and be concerned about that. That may be one of the reasons why we're getting this downward draft in the markets. If we take a look at the VIX, we can see that there's a triangle forming here. Not the greatest, but certainly one to pay attention to because there's a lot of touches of the line, especially on the higher lows there on the downward trend line. But we do have a pretty decent triangle, so it looks like we are going to get some sort of a move in volatility here in the not too distant future. Maybe we move into the seasonal trends and the market begins to move back to the upside as we head into the end of the year, or maybe we get a downside breakout further in the market where we eclipse that low that I was talking about and head down and hit this target down here at the 100% extension, and that would certainly create a spike in volatility, I would imagine, if we take out that low. So I think next week's going to be a very interesting week to see what happens, especially with this pattern in the VIX for a breakout looking to come. On TBT, looking at our case studies, remember we had the triangle pattern here with rates, and we moved to the upside, but it was never confirmed. We came back down, talked about the fact that we usually don't go past that point if you're just testing the breakout and then turning around and going back to the upside. So there's a distinct possibility that we could continue lower. I think if the market breaks further to the downside and the VIX breaks up, that very likely could happen. If the market does start to follow seasonal trends and move back to the upside, then we certainly could have interest rates head back up as well. Just going to have to wait and see. Market will do what the market's going to do, and with the triangle on these triangles, we don't really care which way the market ends up. With MasterCard, we did break to the downside a little bit last week with some of that further move down, but look, we're only at a 36%, so call it roughly the 38.2% fib retracement level, which is actually one of my favorite levels, the 38.2 and the 61.8. So we're still in the qualified upward Elliott wave larger pattern, and we'll stay in this position because, as again I've mentioned many times, with a butterfly, time decay does not work against you, so you're not in a big hurry when that occurs. In fact, taking longer is actually a good thing, not a bad thing. Looking at our triangle pattern and triangle on Unilever, we had a move that broke to the upside. However, it has not been confirmed. So as with TBT, we're back to the breakout point here, and it did move back to the upside just ever so slightly with a doji there on Friday. So we'll see which way things break out. There's an earnings report on the horizon as well, so that could be a catalyst to make it move. But this stock, as you can see, likes to consolidate and break out. It does it a lot. So it goes through these consolidations and then moves, and when it moves pretty significantly. So we'll wait and see how that plays out. Now, last week we added a couple of bullish Elliott wave patterns, and again, reminding you of the downward move that occurred last week in the markets following this zigzag pattern to the downside. But looking at two bullish patterns with AutoZone staying in its wave 3 to the upside. We did have a breakdown and came back and filled that gap, but it's still it looks pretty strong, so you follow the pattern. And again, as I mentioned last week, it's a good hedge for portfolio management. If you're trading the downside, by the way, should mention that we did close out the put debit spread that we had on with the volatility elevated, again as evidenced by the VIX. We did a put debit spread to the downside. We do not do butterflies to the downside. If you've watched these recordings, you know that. But it was a great trade. We were in it 2.5 days, and it returned 72%. Some people got more than that because the market was moving right after we sent out the alert to close it. But that was really nice, and that was all just based on this downward zigzag pattern in the C wave. But with the normal seasonality of the markets on Wednesday and Friday, it was prudent to take a quick profit, especially when you can get that significant of a profit in a short period of time. However, as it played out, the market didn't move up on Wednesday and Friday like it normally does, and the position probably would have gained even more, but a profit is never bad. You don't look back and you don't second guess. We will watch this, and if we can get this gap to fill and turn around and look like we're heading back lower, we will likely just re-put on that alert. We just want to see that gap first, or at least I do want to see that gap filled first, and then that would be an idea. The markets don't always work ideally or the way we would like them to, but if we bounce back up and fill that gap, it would be a great entry for another downside position. So AutoZone's still looking good in its wave 3 higher. Last week we talked about Clorox as well, and I mentioned on the DMI that I would like to see the ADX, this black line here, move above 20, which it did. It did that on Monday's trade. So we have a bullish position here as well, and it's held in there very well, even finishing with a nice up day on Friday. You can see up $3 on Friday when the market was to the downside significantly. So again, you can put a whole lot of weight into what happened in the end of last week with the low volume, but you can see how this is a defensive type of a name with the market going to the downside and money actually moving in here into Clorox. So there's no new case studies for this week. We'll continue to monitor the ones that we have now. Not enough going on right now, and the searches didn't show anything that would qualify to put on a position anyway. So we'll see how this week plays out with the return of volume coming off of our holiday weekend. So that catches you up for this week's trade. Hope you've had a wonderful week, and we'll be back to talk to you again next week. Take care, everybody.